Stock Market Mastery by Chowdhury Zishan, my friends, my followers, and my global community. Welcome. If you are listening this, it means you have made a conscious decision to stop treating your limited time for money and start forcing your money to work for you. Welcome to this explainer. Look, today we are taking a definitive step forward. For way too long, the financial elite have built this massive, intimidating wall of confusion around the markets. They use complex math, intentional jargon, and these crazy, intimidating charts to make you believe that investing is some sort of dark art, reserved exclusively for Wall Street insiders and people with Ivy League degrees. But let me tell you, that is a complete lie. The market is actually a beautifully logical machine. It operates on predictable rules, structural patterns, and human psychology. So right now, I want you to step into your new role. From this moment on, you are the CEO of your financial future. We're leaving Wall Street's intentional jargon behind, and we're looking directly under the hood of global wealth. Okay, let's dive right into the structured roadmap so we can completely rewire your investing psychology. Today, we're going to cover number 1, a test of character. 2, the dual destructors. 3, the professional mindset. 4, eliminating FOMO. And finally, number 5, treating losses as business expenses. All right, jumping into Chapter 1, a test of character. We are stripping away all the external noise here, the flashing ticker symbols, the frantic news anchors, because we need to focus on the true battleground of wealth, your own head. I want to ask you a really provocative question. Why do most retail investors fail? I mean, every single day, millions of incredibly ambitious, hardworking people save what little they can. They hustle, they grind, but they still watch their hard-earned wealth just kind of melt away under the quiet weight of the inflation tax. And when they finally do decide to step off the sidelines and get into the market to protect their purchasing power, well, the vast majority of them end up losing their capital. Why? Is it because they lack intelligence? Absolutely not. The powerful truth, and this is absolutely crucial, is that the stock market is less a test of intelligence and way more a test of character. Honestly, the failure of the average retail investor rarely comes down to choosing poor companies. Actually, it's almost entirely due to an inability to control emotional responses to price volatility. Think about it. When the numbers on your screen flash red, human instinct triggers a basic survival reflex. But in the financial ecosystem, acting on that primal instinct is exactly what transfers your money straight into the pockets of disciplined professionals. Which brings us to Chapter 2, the dual destructors. Now, I gotta warn you, the primary enemies that sabotage wealth are highly, highly predictable. In fact, market algorithms are basically designed to trigger them. It all comes down to the ultimate trap: greed and fear. Greed is what forces the uneducated crowd to buy at the absolute peak of an aggressive market bubble. They see everyone else making money and blindly jump in at literally the worst possible mathematical moment. On the flip side, we have fear. Fear forces that exact same crowd to panic sell their absolute highest quality assets right at the bottom of a market correction. And this brilliantly illustrates exactly how emotions destroy capital. You buy high out of greed and you sell low out of fear. It is the exact opposite of what a logical machine requires to actually generate a profit. Let's pivot to Chapter 3, the professional mindset. So, how on earth do we stop being victims of our own psychology? Well, it requires a total paradigm shift. The secret weapon of the financial elite is defined right here: emotional detachment. Professionals evaluate price charts and financial metrics without any emotional response whatsoever. You have to remember the mechanics of what you're actually doing. A stock isn't just some glowing number on a screen. It represents a legal document of fractional corporate ownership. You literally own a piece of their inventory, their real estate, their future cash flows. Elite investors view the market mathematically. They completely detach their feelings from the structural turning points on the screen because they know they are simply exchanging capital for business assets in a digital matching engine. And because they have that detachment, they arrive at this conclusion: price drops are viewed as wholesale discounts on great businesses, not reasons to panic. Now, what's really interesting about this slide is how it turns fear entirely on its head. Think about it like this. If the local shop down your street suddenly put all its highly profitable inventory on sale for 40% off, you wouldn't run away terrified, right? No way! You'd buy as much as you could possibly afford. Well, professionals treat the stock market exactly the same way. A red day? That's just a wholesale discount day. Moving right along to Chapter 4. Eliminating FOMO. To combat the dangerous allure of FOMO, the fear of missing out, we need some actionable behavioral fixes. Let's look at the predictable life cycle of hype. Step 1, an asset shoots up in a vertical line, Boom. Step 2. Because of that massive move, it hits the mainstream news headlines. Step 3. The uneducated crowd sees the news and rushes to buy out of pure envy. But look closely at step 4. By the time it hits the news, the safe money has already been made. Chasing headlines is just a guaranteed way to hand your hard-earned money to the disciplined professionals who bought quietly before the hype. A master investor completely ignores the noise, They just wait for their own structural setups. And that brings us to our final pillar, Chapter 5, Losses as Business Expenses. We absolutely must change how we view risk and failure if we want to survive long term. Let's compare a losing trade in the market to a retail shop paying its monthly rent. When a shop owner pays rent or a utility bill, they don't cry and view it as a personal failure, do they? Of course not. It's simply the cost of keeping the doors open. So the crucial point is that, in this business, a losing trade is not a personal failure, but just a standard operating expense. Listen, you will have losing trades. It's mathematically inevitable. But if you manage your risk, those losses are really just the small rent you pay to participate in the wealth-generating machine of the global markets. Which leads us to these essential rules for your new role as CEO. First, protect your capital at all costs. This is rule number 1, because compounding, that snowball effect of wealth, can only do its heavy lifting if your capital is actually secure. Second, internalize the lessons from your losses. Third, practice the mechanics daily. And finally, let go of the need for overnight riches. Seriously, if you want a quick gamble, go to a casino. But if you want true financial freedom, you have to treat this like a real business. As we wrap up our analysis of market psychology today, I really want you to let this fundamental truth sink in. True wealth is built brick by brick, trade by trade, and year by year. You are stepping into a system of predictable rules. The market doesn't care where you started in life. It only rewards discipline and patience. By conquering your fear, detaching from greed, and managing your risk like a professional auditor, you take back control. The journey to a portfolio that completely covers your cost of living, it begins right here, in the mind. So the big question is, are you ready to maintain this professional discipline when the real volatility hits? For next chapter, subscribe to The Chill.